Has the recent turbulence run its course or not? The VIX today certainly suggesting a more calm environment as it is actually back below 30. Feels like forever since we've seen that. Let's ask Adam Parker what this is all about. He's the founder and CEO of Trivariate Research, the CNBC contributor. Welcome.
Good to see you, as always.
Sat down and you're like, wow, it's a little calmer. And I was like, that's a good thing.
It is.
Actually, right? It feels like, let's like catch our breath and try and figure out where we are. What would you tell people now?
You know, it's funny. I have a dinner coming tonight with like 7 or 8 CIOs. I'm curious to see who's bullish, who's bearish, and get the landscape cross asset types. But I feel worse about the equity market right now than I did a week ago, only because we're up, and I don't have any more certainty about how long these tariffs are going to last. I think everybody in the world knows guidance isn't going to be great, or if there is guidance, but it's just hard to know. If my original assumption is, okay, my 2026 earnings are now my 2027, it's been pushed out a year, stocks are down enough that that's about in the price and we're back to even, or if people now are expecting this recovery that I don't think will be the same V-shaped economic recovery we've gotten in previous cycles. That I'm a little worried about that. Look, there's nothing worse. I mean, the best thing is you can be a contrarian bull and be right.
Well, I was going to ask you about that.
I love that.
So the 9 CIOs that you got dinner with tonight, how many hands are going to go up in the air for bullish?
So
hardly any, right?
We forced them, and the same crew was here at the beginning of the year in January. Only me and one other were bearish first half of the year. Everyone else was bullish. It'll be interesting to see if now that the market's down, they're all bearish or not. It'll be an interesting, tell signal.
You had the Bank of America fund manager survey today was like the most negative or one of the most negative in 25 years.
And so that feels like, oh man, I want to be there. It's just, I think in this case, like more uncertain, and every ounce of me wants to get bullish when everyone's bearish, but uncertainty is supposed to be bad for multiples, and what's coming on the other side of this, isn't going to be fiscal stimulus, balance sheet expansion, and a lot of Fed accommodation, which is kind of accompanied the previous recovery. So it may be a little bit of a slower fundamental path, and so therefore, I don't know if we snap back to whatever everyone's targets were. It's only April. In January, everyone had 7,000 targets. Now that seems like a mile away.
Okay,
because 2 years away.
You did have more target cuts. Wells Fargo Investment Institute to 59 to 6,100. That's their range.
Yeah.
Jefferies to 53. Everybody has dialed it
59
back.
to 61 would be great. I mean, that'd be double-digit returns. I think we'd all sign all of our money in that right now.
That feels like a home run for sure.
Yeah.
You said fewer rate cuts or a less accommodative Fed. What if we actually get more than we think at this point? I thought Waller's comments yesterday were pretty interesting. If you figure that inflation is going to continue to come down, both because it was already trending that way and if there's a pullback in demand, that the Fed now is going to be uber focused on the labor market. And if now we start to see the labor market start to soften even further, the Fed's going to become more engaged. And they're going to do whatever they have to do to keep that from fully falling apart.
So I have 2 responses to that. Well, 3. One is, I don't know. Okay. 2 is, I think you can look at the prices of things that are made in China and other areas at big stores, at Target, at Walmart, and Costco, and track if they're getting more expensive, toasters and things. Let's just see, because I don't know if I believe prices are going down. I think the big debate would be, sure, if we're really going to have a recession, prices go down, but are stocks going to act great if the economy rolls? So that's like the tension.
But when are you supposed? When are you supposed to buy stocks when it looks bad if the Fed's getting engaged?
So I think it's right, and I think the last point is like I track really carefully the relationship between the perception about rates in the future, the so-called 12-month forward, 24-month forward Fed fund futures, and price to forward earnings of stocks. I know that in the last cycle, you saw they were hiking, and at some point people said, I don't care, they're still hiking, they're almost done, I'll buy stocks. That was day 1 of 2023, right?
It's just now, don't fight the Fed, right? You get ahead of whatever's going to happen.
But now I'm sort of saying, okay, well, things ripped in 23 and 24 when we knew they were going to be accommodative, and they were, but at some point, if they do 50 or 75 more, it's not because I'm psyched about the accommodations, because things are eroding. I actually think what's interesting to think about a little bit is, maybe some of the data we saw from the financials isn't as bad as people thought, right? It's not like the guys who run banks are morons. They have a lot of data, and they weren't going to say, like, things are fine in March, and we don't know about April. They kind of told you, generally, that things are holding up a little better.
They were able to give guidance when most people and other companies can't give anything.
Like, I didn't see, if you really look at the underlying businesses at BAML, at JPM last Friday, I didn't see them saying, like, the consumer is really tanked off in the first part of April. So the hard data I actually thought was upside surprise, to the bank so far. I would say that's better than I thought.